The falling price of the US dollar has huge implications for the US economy. US consumers benefit a lot from lower import prices. The US has been able to import cheaper and cheaper because of the dollar strength. When personal consumption is up, that's also when US net export growth is falling because consumers are going to be consuming more when import prices are cheaper. And when import prices are cheaper, that generally means our exports are going to be less competitive based on the dollar dynamic. So if the US wants to strengthen its manufacturing capabilities, why doesn't it just try to weaken its currency? If we want to make our exports more competitive, then we should just weaken our currency. Is that a smart thing to do? It's pretty clear that that's probably not the case. A weak currency is more important in export-driven economies, and that's just not what you see in the US. Consumption is almost 70% of US GDP. Exports and imports are just not a major factor. The US has the highest difference between consumption and exports, so it is negatively impacted by a weak currency. It makes the cost of imports rise. On the flip side, you see some of these other countries, some of the more traditional exporters, China, the UAE, Vietnam, Thailand, their emphasis on a weaker currency makes sense because they care more about their exports being competitive than they do importing cheap goods. So we actually have the largest gap between consumption and exports. We are really consumer dependent. In periods where our exports are getting more competitive and we're exporting more, that weighs on the US consumer, and those are the times where we've had our biggest contractions because stronger consumption is synonymous with stronger GDP growth.